I'm here at Ross Mortgage in Rochester with Tony Abate, just to give a little insight on first-time home buyers and a few programs that they offer.
Thanks, Michael. Appreciate you stopping by. So when it comes to first-time home buyers, I think one of the important keys is preparation and just knowledge about how the process works. The good news is that first-time home buyers, they don't have to have perfect credit. They don't need to have tons and tons of money in the bank, but they need to be prepared and they need to know what to expect going into the transaction.
Okay, Tony, can you tell us how we can obtain a pre-approval letter?
Sure. So a pre-approval is a very critical part of the process for somebody who's looking to purchase a home. The one important thing to know is that not every lender defines a pre-approval the same way. So it's a fair question to ask the lender that a person might be dealing with is, what does it mean when you say I'm pre-approved? At Ross Mortgage, the best way to think about it is that a pre-approval with us, it's a full mortgage application, but it doesn't have a property embedded into it just yet. So we take everything off the checklist that we can. So we're of course running credit. We're looking at income and documentation to support that. We're looking at available assets. We're running automated underwriting tools that will confirm that a person can be approved. So that really all that's left once that person is pre-approved is to find a property that fits within the parameters provided. And it's a two-way street. The way I like to look at it for buyers is the pre-approval needs to meet both the lending limits and requirements, but also their own personal financial limits as well. For instance, if I tell somebody that they can be pre-approved for a house payment of up to $1,500 a month, but in the budget that they've worked out themselves, they don't want to spend more than $1,200 a month, that $1,200 a month, that becomes an important figure. And we kind of walk through the differences of why and how they can apply that into a home search when the time comes.
Okay.
Yeah.
And how quick can you turn around a pre-approval letter?
Yeah, that's a great question. Pre-approvals can move pretty quickly for folks in the right circumstance. So when their credit is very good, money's in the bank, good job history, inside of 24 hours we can give a valid, fully documented pre-approval. For folks that have some challenges, or maybe they just have a complex financial world, for self-employed or multiple streams of income that are variable, it can take a little longer. I would caution potential buyers to be wary of especially online advertisements that talk about instant pre-approvals. And we're talking about a very important transaction that's going to involve a lot of money. It's appropriate to take the amount of time to do it properly and make sure that it's a pre-approval that has some validity behind it, instead of just a sheet of paper that could be generated in a matter of seconds. If a lender is offering a pre-approval and that potential home buyer has not provided bank statements and paycheck stubs and W-2s and all the things that are necessary to be reviewed, it's not a very strong pre-approval. That's an important piece.
Okay.
Yeah.
Okay. And is there any first-time home buyer programs available?
Yeah, there's a lot of great opportunities for first-time home buyers. And the one thing that I would say that, where are we at, Michael? Mid-October right now in Michigan, rents are disproportionately high right now. We find a lot of first-time home buyers that when they move from their apartment to their home, their housing expense goes down. So not only are there good programs available, but the timing is right as well. So the first program that comes to mind is FHA financing. FHA financing has been around a very, very long time. It's a very easy to understand program, but it brings some benefits to first-time home buyers, such as very minimal down payment, 3.5% of the sale price, rather lenient credit standards. You don't have to have perfect credit by a long shot, but if the credit is reasonable, you can go down to a 580 credit score at Ross Mortgage for FHA buyers. And it's also lenient with regard to where that down payment money comes from. So if mom and dad is going to help out, that's not a problem with the FHA financing. There's a conventional loan variant called the Home Ready Loan Program, which is a 3% down conventional home buyer program. Michael, one of the interesting things is that there were some stats that were released last year that suggested that upwards of 40% of potential first-time home buyers believe that they needed a 20% down payment to buy a home. 40%, that's substantial. As in hearing these numbers, you can tell that's nowhere near the truth. Folks can get in for far less money than 20% down. A couple other unique things that first-time home buyers use Here in Michigan, we have the MISTA Down Payment Assistance Program, and that's an acronym, stands for Michigan State Housing Development Authority. And what MISTA does is that they'll provide up to $7,500 that first-time home buyers can use towards their down payment and closing costs. So it's a great program. It does have some geographic limitations, and it does have some income limitations. So it's a program that's designed for people that need that assistance, not just an extra gift for somebody who doesn't need that type of assistance. It's not a grant. It is a loan that the home buyer does have to pay back when they sell their home. But when they own that home, there's no monthly payments on that $7,500. It doesn't accrue interest. It just kind of sits there. And when they sell their home, they pay that money back to the state of Michigan. It's a good program.
Wow. Okay.
Yeah. Folks often ask about zero down financing. The one program that comes to mind is what is often called RD financing, or rural development financing. Again, much like FHA, it's a program that's been around a very long time. It is a zero down payment program, and the intent is to encourage home ownership in areas that are rural and semi-rural in nature. It's not meant for financing a farm, but if you have a home that is in those semi-rural and rural areas, and it's eligible, then 100% financing at very, very reasonable rates is available. We have a tool that we can use so that if somebody is looking at certain properties, we can just punch in an address, and we can determine in a matter of seconds if the home is eligible for RD financing or not.
Okay.
Good program. A lot of good programs out for first-time home buyers.
Okay, I think that's excellent. And Tony, so I have PMI on my house currently, and if I wanted to get out of my PMI payment, what are the steps I would need to take to make that happen?
It's a great question. So PMI, private mortgage insurance, that's what a lot of homeowners have when they purchase a home or refinance a home. They have less than 20% equity. It's usually in the form of a monthly payment that's added onto your mortgage payment. And of course, what's the number one goal that folks want to do? You want to stop paying it as soon as possible, right? So there's a couple things. First off, if you do nothing at all and your loan balance reaches a point where it represents 78% of the value of the home at the time you purchased it, it's going to roll off automatically. Okay, and that's a regulatory requirement. Lenders don't have any latitude on that. If you were to, for instance, many people they'll make extra payments on the mortgage. It's a well-known tool. You build up equity much more quickly if you throw even just a little bit extra on your mortgage. So if a person pays down their mortgage and they have 20% equity, and they alert the lender that they're making the payments to, hey, I believe I've got the necessary equity, I don't want to pay this PMI anymore, then the lender has to respond to that request. Now, it's not automatic. There's a couple things. They may probably will require an appraisal at that time. The loan has to be in good standing. If a person has missed a couple payments or been late, the lender's not going to be so quick to pull that mortgage insurance off. And then lastly, in a case where a person had PMI on that loan and it's a primary residence purchase, they have to still be living in that property or the lender's not going to remove that PMI. So it's not difficult, and my goodness, and on day one where the math works out, I would encourage anybody to work to get that PMI removed.
Okay, now does that hold true even for today? If I was to slide into a FHA loan as a first-time home buyer, can I still have that PMI eliminated over time?
FHA is different. So FHA, let me kind of back up with the explanation. So PMI stands for Private Mortgage Insurance. It's what's used in concert with a conventional loan to allow somebody to finance a home with less than 20% down. FHA financing provides the same thing. An FHA loan is not a loan from the government. It's a loan that's insured by the government through HUD. And so you could almost look at it as this is the government's competitive program for an insured low down payment loan. So the difference, though, and it's a good topic that you brought up, is that at present, the mortgage insurance on an FHA loan cannot be removed. If it's a 30-year fixed-rate FHA loan, it's on there for the life of the loan. Now, there's chatter that is going on in Washington that is looking to change that and put it more in parity with the way that PMI works on a conventional loan. I think it's going to happen, and it used to work that way. Coming out of the recession, when there were a great deal of claims being paid out for foreclosures, that's when FHA changed their stance and made it for the life of the loan. So if FHA does go forward with that change and make it removable, that'll make it a more competitive program with the conventional loan variants.
Okay, now with conventional. So conventional, I do have to remove the private mortgage insurance once I have 20% equity down.
That's correct. Yeah, you're using the method that we described a moment ago. FHA, for the most recent batch of loans, I should say, before a certain date, if somebody has an old FHA loan, then it 8 years. A couple things. 30-year whatever, you can really look at that as the minimum. So a person can do a couple things. Number one, they start making 15-year sized payments, and we can help with that calculation. Using round numbers is $1,000 a month, and mathematically $1,300 a month would amortize that loan over 15 years. Then they can start paying $1,300 a month, and that schedule will kick in. Okay. The other thing that a person can do, of course, is refinance out of a 30-year loan into a 15-year loan. And the legitimate question is, well, why would I do that if I can just start making 15-year size payments and not have any cost to do so? And the answer is you might have a more advantageous rate that's available to you when you refinance into a 15-year loan. It's a shocking difference in interest expense between the two, that's for sure. So it's worthy of a look if somebody feels that they can afford that payment.
Okay, and if offered to pay points down versus APR, what can you tell me about that?
Points, yeah, great topic. And the interesting thing is, let's back up a step and talk about what it is. So a point is a dollar amount that's equal to 1% of your loan amount. So if I'm going to borrow $200,000, 1 point is going to cost me $2,000. Okay, 1% of the loan amount. As I pay points in exchange for that, the lender is going to give me a lower interest rate. And using a real rough rule of thumb, for every point that's paid, an interest rate is going to go down by about 0.25%. Okay, so when the question comes up, should I pay points? The question is really answered with another question, and that is, well, how long do you think you're going to be in that home and in that loan? So just kind of shortcutting what happens between the two, taking a higher interest rate and not paying points gives you a more immediate short-term benefit, right? Because you haven't paid that money out of pocket. Getting a lower interest rate and paying points gives you a longer-term benefit. So when you do the math over the course of a 30-year loan, clearly it's better to get that lower interest rate even at the expense of points. But Michael, we have to kind of look at some practical pieces of that too, right? I mean, the number of people that get a mortgage and see it to the end of 30 years, kind of in the minority, right? Life happens. They sell a property, they refinance it, they have the ability to pay it off. A lot of things happen. So the other analysis of that is a break even. And so going back to my $200,000 mortgage, if I have the option of getting 4% and not paying any points, or 3.5% and paying 2 points, at a very minimum, when am I going to get that break even? Okay, when am I going to get that $4,000 back that I paid for the 2 points? And if we did the math today, you'd find out that it'd be about 6 years. So as you can see, paying points is a good long-term benefit. It's not necessarily such a good short-term benefit. The other thing that kind of layers into that is that, at least as we sit here right now, rates are already really, really low. And so many folks come to the conclusion of, yes, I see the math, I see the break even, but this payment is right about what I was expecting. It's within our budget. It's what we thought it would be. I don't need to pay extra money out of pocket now for an incremental monthly saving that's going to be there for the life of the loan. Points aren't necessarily a bad thing, but a person needs to evaluate what their expectations are for home ownership. And here's another really important thing. We all do things online now, don't we? We shop online, we research online, but that's our go-to. For almost every lender that will publish interest rates online, that interest rate is published on the assumption that the person is going to pay points. So the rate looks great. It's nice and low. It looks really attractive. And you kind of have to scroll down. You have to get out your magnifying glass and look at that disclaimer print, and it might say something like, this assumes a 25% down payment. This rate assumes a loan of $200,000 or more, and this rate assumes that a person is paying 2.5 points. Now, all those are true and accurate statement, but it might not be a real reflection as to what consumers are doing today. So I guess I would caution people on drawing conclusions by just looking at rate. You gotta look at the whole package. What's my rate? But also, what are my closing costs and what kind of points, if any, are paying? That's the only way to really evaluate it.
Okay. I think that's really good insight, Tony.
Thank you. Yeah.
I do appreciate that.
Absolutely. Yeah.
And again, I'm here with Tony Abate with Ross Mortgage in Rochester. Thanks for viewing.
Thanks, Michael. Appreciate being on.
Thanks, Tony.
Yep.